The Dow and the S&P 500 rising to record highs Friday as investors shrug off a stunningly weak jobs report. Well, let's get some insight into that from Phil Blancato. He's CEO of Ladenburg Thalmann Asset Management. Welcome back, Phil. Beautiful shot there in the golf course, by the way. Stunningly weak jobs report for April, 226,000 jobs, and economists are expecting nearly a million. Do you see this as a blip? Is this a one-off?
I think it is a one-off. There are some very unusual circumstances taking place. For example, there are multiple chains in the country that are requiring some sort of signing bonus, additional personal benefits, a variety of different items to try and entice people to get back to work. And what we're seeing is those are not only quite unusual, so far not effective. Now, whether that's because they're receiving additional government aid or is it a COVID-related item, certainly some combination of both is resulting in a labor shortage. And it showed up in these data this time around. And it's a concern because at a time when we really need euphoric economic data, when we saw some solid data in retail spending, we see core CPI going higher, we saw PCE come in some strong numbers. So the beginnings of it are there. But if the labor market doesn't get hold, then we have a problem. One good sign, though, is that when you look inside the data, average hours worked did tick up, earnings did tick up, and weekly unemployment claims came down quite low. So I think it's just a bad month. Let's see what the months to come, but it's going to be critically important that we get the labor force going again.
Are you surprised that stocks are rallying as broadly as they are?
I'm not surprised we're not seeing a broad-based sell-off. I think the market's willing to accept one bad month. However, if this is a continuum where it takes until September, October to really burn this off, that's a very different narrative. And to be quite honest with you, the market's probably overdue for a mild correction. We could see a 5 to 10% correction to kind of get some of the excess in the market. There's a lot of froth. So this is the beginning of what I would expect to see a more volatile period because we're going to be so predicated on this necessity of great earnings returns and great unemployment data.
Well, Phil, with this big miss, do you think it'll mean that the Fed will not move quickly to raise interest rates?
This is exactly what the Fed wanted. They needed to justify their position. Remember, the Fed has bought themselves 2, maybe 3 quarters of an opportunity to say, we expect inflation to run hot. You could see CPI come in here in excess of 2.5% to even 3%. When we look at the price of plywood, steel, hotel rooms, flights, all going higher. So the Fed needed justification for this, holding on at a time when they really expect inflation to run hot. But now this labor market is indicating, which is one of their mandates, that they could stay easy simply because the labor market's far from being healed, and it gives them the mandate they're looking for.
Well, Phil, if we're getting a positive market reaction on such weak data today, does it mean that if we get strong data later on the weeks ahead, that the market will react negatively?
I think it's different than in the past. Remember, we used to want bad data to make the Fed ease. Now the Fed is so easy, the market really is going to require positive data. And today we saw a shift towards growth stocks again. It's kind of that we're not quite open for the reopening trade just yet, so the market's looking for opportunities. But the reality is the stock market still thinks we're going to get exceptional data. There has been really strong data before this with just about everywhere you look. When look at ISM services, ISM manufacturing, still greatly in expansion. They cooled a bit, but still real strong data from the overall economic outlook.
And lastly, Phil, you noted the shift to growth stocks. Given the current environment, how should investors reallocate their assets? What are the sectors that investors should bet big on?
Far and away, it's time to pivot your portfolio. You need to shorten your duration on fixed income. We're seeing yields go higher. They've cooled a bit. I still expect the 10-year to get to 2.25%. Shift towards higher quality, shorten your duration. Then the reopening trade has just begun. I don't buy into the rhetoric that it's already overpriced. I don't buy that at all, especially in small cap value. Shift to the value side of your balance sheet. You can still have a tilt to growth, but it's time to take some profits, especially on a day like this. So take some profits, shift towards value, go down in cap, and then look to overseas markets. China had an 18% GDP growth in the first quarter. Take advantage of an opportunity to see excess earnings, excess growth, politics aside. I think there's an opportunity to change your portfolio here and enjoy the ride through the rest of the year.
All right. I hope you're enjoying your ride on the golf course today, too. Where are you, by the way?
Thank you. I'm up in New York State at Leawood Country Club with some clients and some friends.
Lovely place. Thanks a lot, Phil, for your thoughts.
Thank you. Take care.
Our thanks to Phil Blancato of Ladenburg Thalmann Asset Management. I'm Fred Katayama in New York City. This is Reuters. Have a great weekend.